Welcome to the chip market, the place to be if you want to invest smarter in the world of chips. Now, for the last couple of years, there's been one name on everyone's lips: NVIDIA. After a truly mind-blowing run, fueled by the AI revolution, the question on everyone's mind is, what happens next? Is this company a sustainable growth engine for the future, or is it a rocket ship that's burned through most of its fuel? Today, we're going to unpack all of it. So how are we going to tackle this? Well, we've broken it down into 4 key parts. First, we'll ask if this is a familiar story by looking at some historical parallels. Then, we're going to question the idea of infinite demand for these GPUs. After that, we'll dive into the in-house silicon race, this growing threat from NVIDIA's own customers. And finally, we'll wrap it all up by outlining 3 potential futures for the company.
All right, first up, before we can even think about where NVIDIA is heading, we have to appreciate the sheer scale of its recent climb. But the real question is this kind of explosive growth something totally new, or does history offer us a kind of a cautionary tale? Let this number just sink in for a second. 117 times. That's the growth in NVIDIA's stock over just the last 9 years. I mean, that's the kind of performance that doesn't just make headlines, it completely rewrites the rulebook for the entire market, creating trillions in value and putting NVIDIA right at the center of the technological universe.
So when you see a chart that goes straight up like that, you have to ask yourself a really fundamental question. Are we watching the birth of a generational company, something that will define the next decade, kind of like Microsoft did with software? Or are we just sitting at the very peak of another massive hardware supercycle, one that, like all the others before it, is eventually going to come back down to earth?
You know, this whole situation might feel brand new, but the parallel to Cisco back in the dot-com bubble is, well, it's pretty hard to ignore. Cisco made the essential plumbing of the early internet, the routers and switches. Their stock just exploded because the thinking was, hey, every company on Earth is going to need more and more of this stuff forever. Until, well, the music stopped, and everyone realized that demand wasn't a bottomless pit after all. And today, when you see NVIDIA trading at about 118 times earnings, it feels hauntingly familiar.
And look, Cisco isn't some one-off story. Tech history is just full of these hardware cycles. Remember Intel in the late 2010s? Years of total dominance led to some stumbles in manufacturing, and boom, a much smaller AMD came in and grabbed a huge chunk of the market. Or how about smartphones? Just explosive growth, year after year, until around 2016, when the market just hit a wall and has been pretty flat ever since. The takeaway here for investors is pretty stark, right? Dominance that's built on selling hardware can be surprisingly fragile.
Okay, so that brings us to the big question. Can NVIDIA actually defy history? Can the demand for their GPUs just keep growing to the moon? Well, there are some serious pressures building up, both from a cost perspective and a performance perspective, that are really starting to put some cracks in that story of infinite growth.
There are really 2 big problems brewing under the surface for the AI hardware market. First, the price you have to pay, not just in dollars, but in electricity, to get that next big leap in performance is becoming just astronomical. And second, the actual gains you get from these incredibly expensive new models are frankly starting to look a little less impressive.
And this table, wow, it really just lays the whole dilemma bare. The current H100 GPU is already wildly expensive and a total power hog. Now look at its successor, the Blackwell B100. It's going to cost even more and use even more power, all for about a 2.2 times performance bump in training. So you're a CTO, are you really going to spend even more money on capital and power bills for that kind of return? The math is getting pretty tough.
And you know, this isn't just a hardware problem. It's happening on the software side too. Reports are coming out suggesting that even the most advanced AI models are running into a wall of diminishing returns. So if just throwing more and more GPUs at a problem isn't giving you that next big breakthrough, then the whole incentive to constantly upgrade to the most expensive new chip starts to fade away fast. And all of this feeds into what we call the good enough phenomenon. The reality is, for a huge number of AI jobs, especially what's called inference, which is just using a model, not building it, older chips like the A100 are more than capable. And think about it, if your business can get the job done with last year's model for way less money, why wouldn't you? This puts a natural cap on demand for the absolute latest and greatest. All right, so we've got pressure from diminishing returns, but that's not even the whole story. There's a huge threat emerging from a place you might not expect: NVIDIA's own customers. Let's dig into how this race for custom, in-house chips could completely change the game. Check out this number, almost 88%.
That's how much of NVIDIA's revenue is tied up in its data center business. And that business is basically run by a tiny handful of massive customers, the big cloud providers, the hyperscalers like Google, Amazon, and Microsoft. That is a huge concentration risk. I mean, if just one of those giants decides to change its spending plans, the ripple effect on NVIDIA's bottom line could be massive.
And here's the kicker. These big players aren't just sitting back and writing checks anymore. They're becoming competitors. Google, Amazon, Microsoft, and Meta, they all have the money, the engineers, and, crucially, the motivation to design their own custom chips. Why? To slash their costs and to break free from being so dependent on a single supplier.
Google was really one of the first to jump on this with their TPUs, their tensor processing units. These are chips designed from the ground up to do AI math. They're the engine behind their own Gemini models, and word is they offer something like a 30 to 40% better price to performance for certain jobs.
Amazon's doing the exact same thing inside AWS. They've developed their own chips, Trainium and Inferentia, and they offer them as a direct alternative to NVIDIA's GPUs. They're basically building an NVIDIA alternative right into their own cloud, which is a really powerful move that gives their customers a choice they never had before.
And the race is absolutely on. You've got Microsoft with its new Maia chip designed to run its Azure AI services. You have Meta building their own MTIA silicon to handle the crazy workloads from Facebook and Instagram. The writing is on the wall. The biggest players want to control their own destiny, and that means their own chips.
So what does this all add up to? Well, long term, the trend is becoming pretty clear. While general-purpose GPUs like NVIDIA's are still going to be super important, their total slice of the pie looks set to shrink. You're seeing custom chips, or what the industry calls ASICs, basically chips tailor-made for one specific job, and they are set to grab a huge chunk of the market, which directly eats into NVIDIA's territory. Okay, we've looked at the history, the demand questions, and the new competition. So where does that leave NVIDIA? Let's try to pull all these threads together and sketch out 3 possible futures: a bull case, a base case, and a bear case.
You can really boil it down to 3 core scenarios. The bull case is that NVIDIA's software moat, CUDA, is just too strong, and they remain the essential backbone of AI. The base case is that growth slows down, but they mature into a still powerful but more stable market leader. And then there's the bear case, where this AI hardware boom fizzles out and we see a correction, just like the hardware cycles of the past. So, for you as an investor, what should you be watching? This table breaks it down. These are the signals that will tell you which way the wind is blowing. You've got to keep an eye on that revenue growth. Does it stay sky high or start to moderate? Watch the market share numbers for any signs of erosion. And of course, that valuation multiple. Can it stay up in the stratosphere, or will it come back down to a more normal tech industry level? These metrics will tell the story.
And that really brings everything down to one single critical question you have to ask yourself. Is NVIDIA the next Microsoft? A true platform company with a software moat that lasts for decades? Or is it the next Cisco, the absolute best-in-class hardware company that perfectly rode a massive but ultimately temporary wave? Your answer to that question changes everything.
All right, that's our breakdown. Thanks for tuning into the chip market. This space moves incredibly fast, so staying on top of it is everything. If you got value out of this analysis, do us a favor. Hit that like button, share it with someone who needs to see it, and of course subscribe so you don't miss our next one.